important terminologies when investing into bond. There is this face value. Just a second. So there's face value, there is current market price or present value, coupon, YTM, accrued interest. Duration is actually a measure of risk, interest rate risk. You can consider as of now maturity as a proxy for duration. So duration is, the larger the duration, higher is the interest rate risk. So if you buy a 180-day T-bill, your interest rate risk is negligible. If you buy a 30-year bond, your interest rate risk is very high. And credit rating. So we'll see all this via an example. So I just went to the NSE page to check out what bonds are available, and we'll see this example of IndiGreed. So here you can see, if you this is how the page will open up. If you click here, you'll find the details of that bond, and I'll show you each and everything, how this, what is what over here. So present value, PV, is the market rate at which you can buy the bond. It's 1037. FV is face value, which you can find over here. It's 1000. Payment is the coupon that you'd be getting on the bond. It's so, since coupon rate is 8.2%, I multiplied it 8.2 into 1000 into coupon. So this coupon you always get on the face value. You never get it on the current market price. All right. So coupon is always on face value. You won't be getting 8.2% of 1037. You'll be getting 8.2% of 1000. Maturity is 10 years. If you see, it's maturing in 2031. So maturity is 10 years. Now I'll show you how do you calculate the return that you get. That is actually called YTM. One more thing over here is credit rating. So triple A signifies this is the highest credit rating. The credit rating works like this. Triple A is the highest, then is double A, then you'll find A, then you'll find triple B, and anything below triple B is not an investment grade bond. So you should be generally looking to buy into these, preferably triple A only. Now I'll show you what is the actual return you'll be getting if you buy this bond right now. This can be calculated using the function in Excel called rate. You have to give the maturity. You have to give the coupon that you will be getting, pay PMT. You will be giving the current price. I've written it in minus because that's the amount you're paying. And this is the future value, that face value that you'll be getting at the end of maturity. So your principal that you'll be getting back. And it turns out to be 7.66. This is the actual return you will be getting on the bond. You won't be getting 8.2%. So there are many bonds, if you see, they are showing significant coupon rate. They are showing 8.9% and 10%, but that's not going to be your actual return. Your actual return may be higher or lesser based on the market price of that bond. And this is how you can calculate it. You can calculate it using the rate function. So we covered face value, we covered present value, which is the current market price. We covered coupon, that's the interest that you're going to get. YTM, I showed you how you calculate it. Accrued interest, we'll see. We covered the credit rating, and we covered the duration. Duration, assume it as maturity. It's a slightly trickier concept, but assume it as maturity. Larger the duration, higher is the interest rate risk. Let's see the accrued interest via an example only. So I'll take one of the OTC trades. So we can see over here. Let's take this HDFC Bank bond. HDFC bond. The current market price for the bond is 103.50. So let's do it over here. Present value is 103.50. Face value is 100. Payment is this into 7.87%, and maturity is just 1 year that's left right now. All right, it's 2021 and maturity date is 22. So that's just 1 year left. Now you can just use the same formula to calculate, and this is going to be your yield for that bond. So this is actually what, 1.2 years left. So 1 year and 2 months or something left. So somewhere, somewhat in OTC trades, this is actually given over here. What is the yield? This is not given in the regular trades. So that's what you need to calculate by yourself. This is the return you'll be getting, which is lower than what you get on HDFC Bank fixed deposit actually. And the concept of accrued interest. So if you go to the market to buy this bond at 103, this is the price that would be listed, but this is not the price at which you will be able to buy that bond. Because some people would think that, okay, let's be smart. This bond is going to pay an interest rate uh, on July 2021, right? So we'll be getting an interest of 7.87 in July, and we'll be getting 107.87 in 2022. So we are actually getting, the 7.87 extra. No, that's not how it works. This is the price that is quoted on the exchange, but when you buy this bond, this is the price you'll be paying. Now, how I got to this price? This is the current price plus the interest. This interest into how many months have already passed, like from the last coupon date or from the issue date, divided by 12. This is the price. This is the coupon. This coupon does not belong to you. This coupon belongs to whoever is selling that bond. So you'll have to pay him this coupon as well, because you will be getting this. But have you hold it for 1 year? No. This guy has held it for 10 months. So you'll have to pay him this also. So this 110 is the price you'll be paying to get this bond actually. And then you'll be getting this coupon on July, on whatever it is, 18th July. And this is the amount you'll be getting on the maturity. All right. Let's take an example of a zero coupon bond. I found this India Bull Housing Finance bond. This is a zero coupon bond available. It's maturing in September 2021. So there are hardly some months left. So I've done 7 by 12, 7 months are left. This is the present value. This is the future value. Payment is going to be zero since it's a zero coupon bond, and this would be the return you'd be getting. This is the annualized return. This is not the percentage return. This is the annualized return that you'll be getting. So that's it. Let's go ahead. So I hope you're clear with all these terminologies. It's a little difficult to grasp to these all at the same time, but everything is written. Everything is written on the NSE website. If you go, you can go on Edelweiss website. They also have every bond is quite clearly defined there. Okay. So there are this tax-free bonds that are available for sale. We can see over here. If you go to the bonds traded on the exchange, you'll see in the bond type, you'll see if it's a tax-free bond. So see, this is a tax-free bond. Hoodco, this is the tax-free bond. So in tax-free bond, the interest that you are going to get is going to be tax-free. Capital gains, if at all any, it will be taxable. Now, tax-free means you're not going to get this 8.76%. That's the thing. So the bond is available for 1300. So the return that you'll be getting would be significantly lower. You'll have to calculate it just the way we did for other bonds. But interest that you'll be receiving is going to be tax-free over here. So if you are in a very high income tax bracket, 30%, and you want to have a regular income, this is your best choice. Then there is something called capital gain bond. This is an instrument in which you can park the gain arising out of sale of a property or a land. It may be commercial or residential property or a land. Whenever you sell a property, and if there is a capital, suppose you have a house worth 1 crore, you are selling it for 1.5 crore, 50 lakh is your capital gain, and you're not buying another house. So usually in India, if you buy another house that is more expensive than 1.5 crore, your entire capital gain tax is waived off. But if you're assume that you don't want to buy any other property now, so that 50 lakh is taxable. It is taxable at 20%, adjusted for indexation. But let's keep indexation for a at the side for the time being. So you'll be charged 20% tax on your 50 lakh. 50 lakh is the maximum amount that you can invest into this bond. Let's see how this helps you. So this is the scenario. You got the 50 lakh capital gains. You invest that capital gains into this bonds. They pay you 5%. Current interest rate is 5% for this bond. Uh, that interest is taxable. The interest is not tax free. This is the tax you'll be paying, and after 5 years, this is the amount you'll be having. I have assumed the tax rate of 30%. You apply whatever is whatever is your tax rate that you might invest into someone's, you might be into zero tax rate. So you will get the full amount over here. On the other hand, if you take that capital gains, you pay the taxes of you pay the taxes of 20%. You invest the remaining amount into some mutual fund, and assuming that you are getting 10% over here, this is the amount you'll be having at the end of the 5 years. These bonds have lock-in period of 5 year, and this is how you can buy this bond. You have to fill the forms for it. They are not available online. You have to fill the form. These are the companies, these are the options that are available. These are generally these are government companies, so generally these bonds would be safer. So if you want to avoid capital gain tax, and if you're not, so this is a good option that you have. Now there are other approaches to invest in bond, much easier. You don't have to do all this calculation. You can buy ETFs, you can buy mutual funds, you can directly invest into OFS, because when you directly invest into new issue, uh, the calculations are very much straightforward. And there's one more alternative, that is corporate deposits. So we'll just see them once. For example of ETF, this is the ETF that we have, one of the ETFs, Bharat Bond ETF. It invests into public sector companies, so it's more safer option. They've got their maturities and all. They've got this website where they've listed their maturities and all. This is the kind of return you can expect as of now if you invest into it. And you get the benefit of indexation, like if you get the benefit of delayed tax deferral in if you invest into mutual fund and ETF. I'll show you that in a second. And yeah, so let's go to the tax deferral. So if you invest 1 lakh into a normal coupon bond or into a fixed deposit, assuming the 5% interest rate, 30% tax rate, this is the interest that you'll be getting at the end of the year. After 5 years, this is the total interest you get, and this is your actual return. You don't get 5%, you get 3.5%, because 30% is eaten up by interest every year. On the other hand, if you put the same money, if you are same into 30% tax bracket, if you put that money into a mutual fund, bond mutual fund, or ETF, this is the amount you'll be having at the end of 5 years. This is the tax you'll be paying onto it, 30% of this gain. Actually, it would be 20%. And this is the return you'll be having. So your return is comparatively much higher if you invest into a mutual fund or an ETF. But investing into bond, mutual fund, and ETF is another complicated stuff. We'll be discussing it into some another video. As of now, I just hope that you all are crystal clear with these concepts of investing into bonds. You can just buy it, or you can bid for the government bonds through Zerodha or GoBid. That's all for the day. You can contact me. This is my email ID, this is my Twitter handle, and this is my IG ID. I also keep on posting stock discussions on Instagram, so if you all are interested, you can just follow it. And thank you. I just hope I was able to explain this concept of bonds, and I'll be looking forward to talk to you all in the next video. Thank you.